This is alarming. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, a new report sparks alarms as the Biden administration is on the brink of a 2009-style economic crisis. And this is something that we've been warning would happen, despite the fact that the political elites have been telling us that the U.S. economy is booming on the back of a strong and robust labor market. We'll show you why these reports indicate we're about to see a repeat of the global financial crisis and why it means for our incumbent president, if we're in an all-out recession by the November elections, that his odds of getting a second term will quickly go to zero. But it's not just the U.S. economy is facing trouble. We'll show you why every major industrial economy around the world is facing the exact same problems. Plus, we have a sponsor of today's show. We'd like to introduce CDT Environmental Technology. You can find them on the NASDAQ under the symbol CDTG. And the reason you want to is because this company just recently IPO'd this month. They're profitable. The float on the stock is extremely low and has been holding its value. This creates a potential long-term big investment gain for you. Check it out again on the NASDAQ under the symbol CDTG, or stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where he picked today's story up with a headline of U.S. business activity expands at the slowest pace in 4 months. Now, what we're used to hearing is about how the U.S. economy is booming, but all of a sudden it's starting to decelerate. But it's not just the headline that's the problem. It's what's happening underneath the report that we've been warning about, because all of a sudden we're starting to see what is the beginning of a replay of the global financial crisis. You may remember there was a massive amount of housing inventory then, just as there is now. Oil prices pushed higher, drove inflation higher, but then there was a big problem. The U.S. labor market broke underneath all of it. The S&P Global Flash April Composite Index of Output at Manufacturers and Service Providers slipped 1.2 points, the most since August, to 50.9. This indicates a very slight expansion, as any number over 50 indicates as such a contraction under 50. The U.S. economic activity lost momentum at the start of the second quarter. Now remember, we continue to hear that the second half is going to be booming here in the U.S., so what that should indicate is that momentum continues to build in the second quarter, and yet all of a sudden we saw this sudden slowdown. And we've been warning that this increase in oil prices that everybody says will be inflationary and drive a big second round of inflation. Now, it could send the CPI higher, but one of the underlying issues we've been warning about is consumers could not afford these higher prices. It would eat into their discretionary spending, and now the factory sector is telling us that's exactly what's happening. And April saw inflows of new business fall for the first time in 6 months, and firm future output expectations slipped to a 5-month low amid heightened concern about outlook. Remember, this was very rosy not too long ago. The more challenging business environment prompted companies to cut payroll numbers at a rate not seen since the global financial crisis if the early pandemic lockdown months are excluded. Now remember, the U.S. labor market here is supposed to be strong and robust. In fact, resilient to shocks. We continue to hear that from Fed Chair Jerome Powell. We continue to hear that out of the Biden administration. And yet we've been warning that if we do not see a meaningful pickup in new orders, that at some point the backlogs would get eaten through. There would be idle workers staying around. Employers would start cutting hours and then eventually cutting heads. And now that's exactly what we're seeing, as the decline in employment measures suggest companies see current capacity as sufficient to handle demand. Order backlogs remain in contraction territory during the month, suggesting, just as I mentioned, is we would eventually see the backlogs get worked down and there wouldn't be enough new orders to support all of the workers. And sure enough, that's what we're seeing, as new business and service providers even shrank for the first time since October, with some firms indicating higher borrowing costs and still elevated prices were limiting demand. And that is the key focus here, because this is exactly what we saw heading into the global financial crisis, is that prices were rising, but wages and total compensation were slowing. Consumers could not afford those higher prices, so they cut spending. That led to more people losing their job. And next thing you know, we were in an all-out financial crisis. And this is all about the manufacturing sector, because you'll recall, everyone's been believing that the services sector leads the manufacturing sector. Historically, there's no evidence of that being true. But what the real issue is when people lose their manufacturing job, well, things for the economy tend to get bad. And here we can see the current general business activity for the Philly Fed. We don't happen to happen the S&P Global data in the Fed database, but here what we can see is against continued claims, slowdowns of the manufacturing sector, as S&P Global is suggesting, lead to higher unemployment claims and people staying on unemployment. You'll notice recently we had a resurgence in manufacturing that everybody said that was your soft landing, that was a no landing, we're off to the races. Well, now it's rolling over, and this time employers are laying off, and that is dangerous news for the U.S. economy and the worst possible news for President Biden. Because signs of demand weakness impacted hiring plans at companies in the U.S. at the start of the second quarter, a number of survey respondents indicated that they had held off on backfilling positions following the departure of staff. And as a result, employment decreased for the first time since June of 2020. The overall reduction in workforce numbers was centered on services. Now, this comes as to a surprise because remember, everyone's been talking about how the services sector was going to lead the manufacturing sector. And I've been saying that all these people on unemployment, the longer they're there, their lack of spending power was eventually going to feed back to the economy. Now we're seeing it. And as a result, employment decreased solidly and to the largest extent since mid-2020. In fact, excluding the opening wave of COVID-19 pandemic, the decline in services staffing level in April was the most pronounced since the end of 2009. In contrast, manufacturing employment continued to increase modestly. The drop in staffing levels partly reflected signs that current capacity was sufficient to handle the workloads, and that is an issue because backlogs decreased for the third month running, and get this, to a larger degree in March, suggesting that, of course, there isn't enough new orders, so everyone's been being put on backlogs. As those get worked down to nothing, well, next thing you know, again, hours get cut, jobs get cut, and we are on the cusp of recession in a matter of months. And the deterioration of demand and cooling of the labor market fed through to lower price pressures. Now, this is something we've been saying what happened, and people said, no, that's not how it works, but it is. If you have a business, you can raise prices all you want, but if nobody comes in and buys it, raising your prices more is not going to cause a flood of people. What then happens is, of course, these higher prices are getting rejected by consumers. That means businesses have to lay off staff to cut expenses because eventually they're going to have to cut prices. And April saw a welcome easing in rate of increase for selling prices. There you have it for both goods and services. And this all comes back to the fact that we've seen this big surge in energy as investors around the world have been betting on higher oil prices and higher U.S. stock prices. Of course, the risk now is, if you recall, going into the global financial crisis, we're now seeing this similar setup. Higher oil prices driving inflation, a slowdown in wage growth, leading to rising unemployment. Again, at a time where you see investors crammed in at the peak on stocks and chasing energy long positions. But this is, again, a story for the energy sector. As you can note here, we have total compensation shows average hourly earnings multiplied by average weekly hours. This is production and non-supervisory employees in blue. That's shown on a year-over-year rate of change against U.S. regular all-formation gas prices. That's shown in dollars per gallon. And what I want you to see is, as you see compensation growth slowing and gas prices rising, well, that eats into people's budgets. They can't afford other discretionary spending. They cut spending back. That leads, of course, right into recession. And you see that happen again during the global financial crisis. Now, you remember coming out of the crisis, we almost had a double dip recession, which is obvious because total compensation was falling. And what happened? Of course, gas prices were rising. That is not the combination you want. And now we've been on a long downward trend of total compensation, which we can suggest now is likely to go lower as gas prices are rallying back, eating into consumers' budgets in a big way that they just can't afford to maintain the rest of their spending, leading, again, to other people losing their jobs. And we can see exactly this claim that everyone has that gas prices and energy prices are inflationary. Well, they can be until they're highly disinflationary, as we can note. Again, looking at the dot-com bubble, rising gas prices did cause inflation to go up until inflation came crumbling down. Happened again during the global financial crisis, happened in the aftermath of that as well. Again, rising gas prices, rising inflation, and inflation came slowing down in a big way. Now we're seeing it again. The only difference is everyone believes inflation is going to surge much higher, and while in the short term it could rise, it's suggesting, based on historics here, that it's going to head lower in a meaningful way and likely in the near term. But this isn't just a U.S. issue. It isn't the fact that we're seeing a replay of the global financial crisis, except now you can substitute the U.S. real estate market, the home market, for commercial real estate. Except this time, there's a big difference, one big key one. The banks said we're actually in decent shape. Today, we know the small, mid-sized regional banks holding all these commercial real estate loans are already insolvent. You want to make the case Fed heading back to zero? Well, you've got all the evidence you need. And it's not just a U.S. phenomenon. Here we can see, looking at the United Kingdom, what do we see? The fastest expansion of output since May of 2023, but cost pressures intensify. They're trying to put lipstick on a pig here, because looking at the manufacturing PMI, it went from virtually unchanged last month at 50.3 to contraction of 48.7, a two-month low. And here you can see they're tooting the horn of the service provider, saying, look, everything's great in the services sector, but manufacturing production declined slightly in April, reversing the positive trend seen during the previous survey period. Lower output levels were often linked to weak market conditions, and here you see customer destocking in line with reduced demand. So what we're seeing here is businesses saying, look, I don't have a whole lot of demand and I've got a lot of inventory, so I'm not ordering until I get these inventory levels down, and demand along the way is falling. But something else that's falling is Germany's, of course, manufacturing sector deep into a depression here. You can see it's hovering at 42.2. That is under 45. That is the key note for what is a depression in their manufacturing sector. Meanwhile, what we see is their services activity rose. So here you see this continued case that everyone's making that the services sector is going to lead the manufacturing sector, but yet we've seen absolutely no historical evidence that's true. What we see is perhaps a transitory move here. Its April's flash survey showed contrasting trends in demand conditions at the sector level. Whereas services new business rose for the first time in 10 months, manufacturers recorded a sharp and accelerated drop in inflows of new work. In fact, demand for services rose moderately at the start of the second quarter, linked in part by surveyed businesses to improve interest among clients. However, this was more than offset by the sharpest drop, that's key, in factory new orders in 5 months. Total new business continued to fall, albeit at the slowest rate in the year. And here's a big one, because you talk about global demand, there was still a considerable drag from falling export business, despite the rate of decline easing to the weakest for 12 months. So what you're seeing is not only internal demand in Germany falling, external demand outside of Germany falling. What you're seeing is the beginning of a globally synchronized recession that we know is going to end in an all-out financial crisis, because on the unemployment front, which is what everyone's holding on to, it was likewise a dichotomy between rising workforce numbers in the services sector and further manufacturing job cuts. The rate of hiring in the services sector quickened slightly and was the fastest seen in the 10 months. But get this, backlogs of work, well, that changed, and they continue to fall across the private sector in April, in line with the trend every month since August of 2022. The rate of depletion did, however, ease to the weakest in a year, maybe as they run out of backlogs, reflecting a renewed marginal increase in the services sector and a softer decline in manufacturing. But look at this, everyone still believes in the services sector, as they say it's a catalyst for the overall economy. Comprising approximately 2/3 of the economy, services companies sound clear indications of a more sustained recovery. In addition, the accelerated growth in services, there are encouraging signs that more forward-looking aspect of outstanding business, which has shifted into expansion territory, this leading to more hiring and optimism. The problem is, as manufacturers lay off, there isn't going to be a whole lot of optimism because the wages in the manufacturing sector are far higher than the average wage of the services sector. So for the moment, we're seeing this bump in services, but hang tight. It usually follows the manufacturing sector at some point. And here we can see the French economy stabilizes in April as renewed expansion in services offsets manufacturing malaise. Again, everybody pinning their hopes on the services sector. Here we see manufacturing go further into contraction, now just tipping into that depression territory at 44.9. Again, all this is telling us is layoffs in a big way are coming as total new business continued to contract during April, with an increase in demand for services insufficient to offset the drag from manufacturing. And that's the point I'm trying to make here, is where manufacturing goes, services falls. So in the meantime, you can see this push as we head into the summer months. People, yes, they want to spend money. The problem is the manufacturing sector is saying, look, there's no demand. When there's no demand there, you get more layoffs. And sure enough, that is indeed the evidence, because the overall rate of decline was modest as a boost from services sector drove the weakest contraction in a year. But new orders placed with French factories felt the steepest pace since January, amid reports of deteriorating demand from clients in overseas markets such as Germany. No surprise, North America should be a shock to many, in Africa. And private sector backlogs of work were reduced to a 9th successive month in April. The decrease, while modest, was similar to those in the past 2 months. And manufacturers registered the quickest depletion in pending orders for 3 months as new sales dipped, while progress on outstanding business slowed across the services sector. So again, we're seeing all this slowdown, a little bump in services, but a broad slowdown continue as French manufacturing output stays subdued. We expect it will soon follow the path of the services sector, or at least as the survey response is suggesting, we're hoping it follows. The manufacturing sector delays the overall economy's recovery for now as the output index dropped for another month, mostly offsetting the services sector activity growth. Weak demand in the manufacturing was a main reason for faster deterioration. This, again, not good news. And even as we zoom out to the overall Eurozone, we see more of this as the Eurozone recovery gains momentum in April, but price pressures also revived. Here you can see Eurozone manufacturing right on the edge of depression at 45.6, marking a 4-month low. Meanwhile, the services sector, unlike the U.S., now making an 11th-month high, as again, hope just goes right through Europe, but this is going to change in a meaningful way. The best that can be said about the manufacturing sector in the Eurozone is the production fell at the slowest rate for the year in April, and the job losses had eased somewhat. Otherwise, the picture remains rather bleak, with new business continuing to decline rapidly, along with order backlogs. Weak demand for industrial products is also evident in the sharp decrease in volume of purchased inputs and the absence of a turnaround in the inventory cycle. So we're seeing no change here. Although we anticipate a recovery in the manufacturing sector by the middle of the year, well, at least they're hoping, it's essential to consider structural factors influencing the sector. China, whose companies increasingly becoming a competitor for local industrial companies, particularly in the area of high tech, is likely to be a significant factor in this regard as everyone starts to compete for less and less business. And that is a danger sign here, because we have all the signs of what we're seeing as a repeat of the global financial crisis. Instead of the residential housing market and subprime, we're seeing it in commercial real estate. We're seeing higher energy prices start to put pressure on the consumer price index, matching a deceleration in total compensation and the beginning now of the second round of layoffs and increase in continuing claims. This spells danger signs in a big way, not just for the U.S., but the total U.S. economy. But one company that is booming throughout this because they have demand and profits, that is a sponsor for today's show, CDT Environmental Technology. You can find them on the NASDAQ under symbol CDTG. All the information in the pinned comment and description below. And I want you to, this is something very exciting because they have a very small float. This could be a huge long-term opportunity for you. Check it out. Let's take a look at what they are, because they have a septic tank treatment system. This is indeed a Chinese company. They're a waste treatment company that generates revenue through design, development, manufacture, sales, installation, operation, and maintenance of sewage treatment systems, and providing sewage treatment services. Again, they're profitable, and they primarily engage in two business lines: rural sewage and septic tank treatment in both urban and rural areas, and they've have established sales. This is critical, and marketing networks in many cities across several provinces in China, with 14 majority-owned subsidiaries and 2 branch offices in China. The core of their businesses are proprietary systems and technology, together with their experience and expertise in waste treatment services, particularly in the rural sewage treatment and septic tank treatment space. They've got 2 invention patents and 19 utility model patents. They've got 5 pending utility patents, and they're continually working to upgrade their quick separation technology and septic tank treatment systems through independent research and development and partnerships with third-party institutions to further develop their mobile septic tank treatment system. And we believe that because of this company's very low float, on the fact that they're a recent IPO, this could be an outstanding long-term investment play. Let's take a look here. You see CDT Environmental Technology Investment Holdings Limited announces closing of its initial public offering, symbol CDTG, that on the NASDAQ. Here you can see they had an offering of 1.5 million ordinary shares at a price of $4 per share. This is a very small offering, very small float, giving you a tremendous opportunity. And here you can see, based on their financials, indeed the company is profitable, and that is also a huge catalyst for this company. And you can see since they issued, the stock has been holding fairly stable, which is great news, because many IPOs, after they issue, you see the stock tumbling. The advantage with CDT Environmental Technology is they're profitable, and it's a very low float, and that tells you this company has got big things coming in its future, and you could be one of the early investors. And with that, I'm Steve Van Metre. As always, be sure to do your own research before placing any trades. And with that, of course, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.